Securities Markets Foundation Part 4. Equity Capital, Features, Types and Risks. This part focuses on equity as a funding instrument, outlining its fundamental characteristics, the different types of equity shares, and the risks and returns associated with this asset class. The nature of equity. Equity capital is the fundamental building block of a company's financing, representing ownership of the business. Denomination and ownership. Equity capital is denominated in equity shares with a face value, typically 1 rupee, 2 rupees, 5 rupees, or 10 rupees in India. Investors buy these shares to become shareholders, who jointly own the company in proportion to their holding, known as their stake. Perpetuity of capital. Unlike debt, equity capital is raised for perpetuity and is generally not returned during the life of the business. Risk capital. Equity is often called risk capital because investors accept the risk that the business may succeed or fail without expecting a fixed rate of regular return. They aim to profit from the appreciation in the value of their shares. Rights and residual claim. Equity investors have residual claims, meaning their payoff is only what remains after all others are paid. Variable return. Shareholders are paid a periodic dividend, but the rate is not predetermined and depends entirely on the business's profitability and available surplus after meeting all costs, including interest and tax. Residual claim. Shareholders are ranked last for both profit sharing and for claiming a share of the company's assets. If a business fails, the proceeds from the liquidation of assets are paid out to all other claimants, government, lenders, employees, before any residual amount, if at all, is paid to equity holders. Net worth. Profits not paid out as dividends are retained as retained profits or reserves, which enhances the company's net worth and ultimately the value of the equity shares. Management and control. All shareholders are granted voting rights, 1 vote per share, on important company decisions. Types of equity capital. In addition to ordinary shares with full voting rights, companies can issue specialized types of equity. Equity shares with differential voting rights, DVR. These instruments separate a shareholder's right to participate in profits from the right to vote. DVR investors often get a higher dividend but have proportionally lower voting rights. Preference shares. These are a special kind of equity that pays a predefined rate of dividend. They resemble debt by offering a predetermined return but differ because their dividends are paid from residual profits. Post-tax, they are generally unsecured, and they do not offer voting rights. They do, however, have preference over ordinary equity in terms of dividend and capital return upon winding up. Risks and returns in equity investing. The returns an equity investor earns depend on 2 factors: the periodic dividend paid out and the appreciation, or depreciation, in the market value of the investment. Volatility and risk. The main risk is that future benefits are not assured or guaranteed. Returns are inherently volatile. Share prices move continuously, reflecting the collective and dynamic expectations of traders regarding the stock's future performance based on all available information. Information signaling. Price movements serve as a barometer of how well a company, sector, or the economy is performing. A rising price signals strong anticipated performance, while a falling price signals deterioration.